Hi, I'm Dean Mioli, Director of Investment Planning for SEI. Today we're going to talk about the Tax Reform Bill, also known as H.R. 1. There's been a lot that's changed, and we're going to cover that at a very high level. And we're also going to cover action items and other considerations. Let's talk about individual tax rates. We had 7 tax brackets in 17. Guess what? We have 7 tax brackets starting in 2018. Well, when you look at these brackets, what we'll see is that most taxpayers, their tax rates are coming down. Let's talk about the alternative minimum tax. There was a huge change here. One is the exemption amount increased significantly from 17 to 18. And even a bigger deal here is that the phase out of the AMT exemption is now much higher in 2018 than it was in 2017. What does that mean for most taxpayers? Well, what it means is that most people will not be paying alternative minimum tax anymore. The second thing is the standard deduction was doubled for taxpayers from 17 to 18, and personal exemptions are no longer deductible starting in 2018. What that means for most taxpayers is that they will not be itemizing. In fact, most taxpayers weren't itemizing to begin with, and now with this new tax law change, even more taxpayers will not be itemizing. So they'll have a simpler tax preparation. Let's talk about itemized deductions. There were huge changes here for individual taxpayers. One of the big changes is now we have a limitation on the amount of state and local and real estate taxes that you're allowed to deduct. For a married couple, that's $10,000. On top of that, there was a change where there used to be a phase out potentially for itemized deductions. That has gone away in 2018 and forward. Also, most miscellaneous itemized deductions that were subject to 2% of AGI means adjusted gross income, will no longer be allowed. And they include such costs as tax preparation, investment expenses, and job-related expenses. And we'll talk about some planning about that a little later. Now, there hasn't been any change to the capital gain and qualified dividend tax rate. Let's talk about mortgage interest. In 17, you were allowed to deduct up to $1 million of primary and secondary residential mortgages. And you were also allowed to deduct up to $100,000 in home equity line of credit, also known as HELOC. Now, starting this year, 2018, the limitation on mortgage interest is now $750,000 for primary and secondary residences. Pretty significant decrease. And going forward, HELOC interest is no longer deductible. Let's talk about the child tax credit. In 18, there was a significant increase in the amount per child from $1,000 to $2,000 per child, and $1,400 of that being refundable. The phase out has increased significantly, so more taxpayers will get the full benefit of that child tax credit. Let's talk about investment taxation. Even though we had a major tax law change, the biggest expense for investors is tax. Now, starting in 18, the top tax rate on ordinary income, short gains, and interest income went down from 43.4 to 40.8, but that's still high. There is tax-favored income, which is qualifying dividends and long gains. That'll be taxed at 23.8 at a top rate. And of course, municipal bond interest remains federal tax-free and potentially state tax-free. And of course, if you don't sell anything at a gain, unrealized capital appreciation, of course, is not taxed. And as an investor, you should be focusing on after-tax returns. Now, one thing to do to minimize your tax bite is to understand not only your asset allocation, but also where your assets are located. Asset location. And here we have a priority list. Now, there are certain asset classes that are quite tax efficient, and certain asset classes, like commodities, which are generally very tax inefficient. So when you're planning out your asset allocation across different accounts, you might want to bury your tax inefficient asset classes in, for instance, your 401k and your IRA accounts, and your tax efficient asset classes like municipal bonds in your non-qualified taxable accounts. Let's talk about the upcoming tax season. You'll be meeting with your tax professionals later this first quarter, and there are some really important questions you should be asking them. One I would be asking is, let's do a tax projection for 2018. How does my tax look for 18 versus what I paid in 17? How will that affect my W-4 withholding? How will that affect my estimated tax payments in 2018? Will I still be able to itemize my deductions? What is the best way for me to donate to charity in 2018? Maybe in 2017 you itemized and you had a charitable deduction. Now in 18 you're not itemizing. Does that change your approach or how you give to charity? Should I do a Roth conversion? That should always be on your agenda. And the fact that HELOCs, home equity lines of credit, is no longer deductible, should I pay that loan off? Should I combine that with my home mortgage? These are all great questions you should be running by your tax advisor. Tax rates have been lowered for most taxpayers, but investment management is still critical to your long-term wealth accumulation. Municipal bonds can still make a lot of sense for taxpayers in the 32% federal tax bracket or higher. Asset location. It's all about location. Own your assets in the proper tax bucket. Tax loss harvesting. We had very low stock market volatility in 17. 18 could be a lot different. And if we get some volatility, there might be some good opportunities to tax loss harvest. Might pay tax on gains before you have to. And if your tax bill is going down, you might want to consider saving a little bit more for retirement. That's a good thing. Thank you very much.